So this is your last class exercise in your series for Chapter 1, and this includes all the parts. So if you're able to work this one on your own, that's very good progress for you. If not, we'll tidy up any leftover pieces that maybe you had from this chapter. So what do they want? They want to know the equity and investee income that should be reported in the 2 years. So what's going into income? What goes into income is the percent of net income. So the parent gets to record their percent of the subsidiary's net income, less a couple of things. If there is any excess amortization, so if the fair value was greater than book value, then you amortize that excess. And if there's any gross profit tied up in inventory from intercompany sales between the parent and the subsidiary, we remove that as well. And if there was deferred gross profit in a prior year that's turning around, we would add that back. Now, what about dividends? Dividends reduce the investment account using the equity method, but they are not recorded as dividend income as they might if you had, if you weren't using the equity method. So let's go ahead and do this for 2014. So for Tall Company, so the 100%, if you will, of earnings in 2014 was 80,000. And what is their percent? So their percent is 25% of that. So that's going to be a positive number. Now we're going to remove the excess amortization, which they tell us here is 40,000, of which a fourth of it's going to Tall Company. So 40,000 is the 100%, and then the 25% that belongs to Tall. That's going to be a negative. You can put it in as a negative if you like. Is there any deferred gross profit in 2014? There were some intercompany sales in 2015, but not in 2014. So in the income statement, the net income, it's a non-operating item on the income statement, that would be reported would be the 20,000 less that 10,000 excess of fair value over book value, the amortization, their share of it. Okay, so what about in 2015? Okay, so the earnings were 100,000. Same thing. Tallco would get a fourth of it, or 25%. And then the excess amortization is still 40,000. And they get a fourth of it. That's a minus. Now we do have some deferred gross profit, so let's calculate that. So the sales between them were 75,000, and the cost was 50. So gross profit is sales minus cost of goods sold, and the percent is gross profit divided by sales. And so that's 333 repeating, so Excel doesn't round, so the threes, even though it's only displaying 2 decimal places, it contains the whole amount. It goes on and on, right? Even though it's displaying just 2. So if you round, you might get a slightly different number. Okay, now that percent goes to unsold. So what was the unsold inventory? It tells you that they continued to hold merchandise at the transfer price of 30,000. So that is our unsold. And the deferred gross profit in that 30,000 would be 30,000 times the 333 repeating. And if you truncate, you'll get 999 or something like that. All right, and then Tallco has 25% of that. All right, and so that's going to reduce the 25,000 as well. So the income would be the 25,000 less the 10 less the 2,500. Again, you can use minus if you like, or if your theory is strong enough, you know that those would be removed. So whichever is better for you is fine for me. Okay, so now it says, how will this sales between them impact 2016 earnings? This 2,500 that's being removed here will be added back in 2016 when the 30,000 is sold to an outside party and not a related party. Okay, and then the dollar amount is the same whether the parent sold it to the subsidiary or the subsidiary sold it to the parent. When we get into later chapters, there'll be a slight difference in terms of minority interest earnings, but we'll get to that later. Okay, so let's do the T account and wrap this all up. So here's all the possible things. The purchase goes in here, your percentage of net income in the first year, your percentage of dividends reduces it, your percentage of the amortization, and so then the second year. So the original purchase was $700,000. It was given to you up here. Your percent of net income, we already calculated that. All right, dividends. So the dividends up here, $30,000 in both years, and we get 25% of it. And then the amortization of the patent, which we already know about. So if we wanted the balance at the end of 2014, we would calculate that right there. We'd add those two up and subtract those two and get a balance. But we're going to keep going so we can get the end of the second year. All right, so net income for the second year, their share. Dividends were the same in both years, so 25% of the $30,000. We're amortizing the patent again. And now we've got this deferred gross profit, which is a credit. So now we can do adding up all the debits, subtracting the credits, and we get a balance. I guess I should put that down there. Get a balance of $707,500. So hopefully that gets you in pretty good shape for the chapter. We will be using this going forward for the next 3 chapters. So if you're not confident in this, let it get a little bit cold, go do something else and clear out your brain, and come back and try to do this from start to finish without looking, and then check it. Okay, ready for the next chapter, hopefully.